All right, let's talk about a trending stock here this morning, and that is AutoZone. Cruising past earnings expectations. The company reported a beat on both the top and bottom lines during its fiscal fourth quarter. But despite beating the street's expectations, take a look at the share price right now. Now, it's still early trading, but you're looking at losses of just about 2.5%. Trading lower after the company's lower than expected growth in its domestic commercial business. Here to talk about that and more, we want to bring in Seth Basham. He's Wedbush Securities Managing Director of Equity Research. Seth, it's good to see you again. So let's first start off with the results that we just got here from AutoZone. Like I said, a beat on both the top and bottom line. Sales up about 6.4% from a year ago. What's your first take of these results?
Yeah, certainly the top and bottom line looked better than expected. However, as you called out, the domestic same-store sales were a little bit weaker than expected, particularly in that commercial segment. Domestic overall same-store sales were up 1.7%. Street was looking for 2.4%. And commercial same-store sales in the U.S., we estimate to be up in the 2 to 3% range versus expectations in the 5 to 6% range. So that's a disappointment. And this is the second quarter in a row that we've seen disappointment for that commercial business, which is one of the key growth drivers for AutoZone. So our initial take is that they still have work to do to improve the trends in that commercial business. The overall business, however, is relatively healthy compared to the rest of the hardlines retail segment.
Okay, so you're saying that they still have some work to do, but you also named AutoZone your top pick in auto parts retail. So kind of put those two together, put those two frames of mind together for us, Seth.
Yeah, certainly. So within auto parts retail, this company has more exposure to the retail segment than any of the others that I follow. So about 75% of their sales are to that retail consumer, and that retail consumer spending on auto parts should be better trending than it has for the last 2 years or so because of the pressures that they're experiencing with inflation and running through their pandemic era savings. So we expect that to be a positive for the retail segment of the industry and therefore be better for AutoZone. Now, if we look at their overall comparable store sales compared to their peers, we're talking about trends that are a little bit better than the likes of Advanced Auto Parts and GPC's Napa Auto Parts division. However, O'Reilly Auto Parts is the clear standout with stronger trends driven primarily by their commercial strength, but to some degree in their domestic retail business as well. So comparing it to O'Reilly, we like the positioning of the company and we like the valuation discount to O'Reilly.
Seth, we have the UAW strike ongoing right now within this sector. How does this then position AutoZone? Does it actually position them pretty well given the fact that, hey, maybe people aren't going to go out and buy new cars if we do see prices rise as a result?
Yeah, to a certain extent, it might lead consumers to hold on to their cars a little bit longer, do more maintenance on their cars. But I think it's a bigger boost for used cars retailers. So there'll be demand shifting from new car purchases to used car purchases, particularly late model used car purchases. And that'll be a boost for retailers such as CarMax.
Yeah, okay, so all of these things considered, Seth, when we think about the number of people that are just looking across the portfolio of it's a nice way to put it, portfolio of purchases that you're making, or just a basket of purchases that you're making. Have we seen any kind of shrinkage in the number of items that they are purchasing, even if they are going into one of the auto parts purchasing experiences right now?
Yeah, overall, the number of items, the unit sales at the auto parts retailers have been down for the last year or two here, and that's because of severe strength during the pandemic. So you're facing tough comparisons. The drivers of comparable store sales growth for these companies have been primarily in the form of price-driven inflation, and we've seen slowing growth in price-driven inflation over the last few quarters, probably down to the low single-digit range at this point in time. So we're expecting unit sales to start picking up some slack here against easier comparisons because of those economic pressures that we talked about.
Seth, rising gas prices, it's something we've been talking about now for quite some time. Is that an overhang on the stock?
Certainly is. Rising gas prices oftentimes leave consumers to drive less, and miles driven is one of the key metrics of auto parts repairs. So if we see that trend continue, it would be a negative.